Welcome to the deep dive. Okay, if your job involves talking about your company's long-term potential, or maybe you're just trying to figure out what stable capital really wants these days, well, the amount of market noise out there is just huge.
It really is. Every little interest rate change, every geopolitical event, some new tech headline, it feels like it shifts investor thinking instantly.
Exactly. So today we're trying to cut through some of that static.
That's right. We've dug into two recent, pretty deep analyses from McKinsey. They surveyed institutional investors, the folks actually controlling the long-term money, to really pin down what they're demanding right now.
Like what metrics really count, and how do companies need to maybe adjust how they talk to investors to meet these higher expectations.
Precisely.
So our mission for you today is pretty straightforward. We want you to leave this deep dive understanding the key financial metrics that seem to be, well, non-negotiable now. Plus, understanding two really big shifts in what investors are focusing on.
Yeah.
And, this is crucial, knowing the actual performance difference between companies that pull in that stable long-term capital.
And the ones that, frankly, push it away.
Right. So, let's get into the core data. Okay,
Right.
First things first. Let's talk foundations. The data seems clear. Investors haven't suddenly forgotten the basics, right? They're still looking for that hard proof of, long-term strength and value creation.
Absolutely. That core focus on fundamentals, it's still key. We're still talking about things like how productive is your capital, how innovative are your products. That hasn't gone away.
But there's a shift, isn't there? The earlier analysis really zeroed in on those operational levers.
Yeah.
Efficiency, innovation, the how.
Exactly, the how. But the newer findings, they show this subtle but important reweighting in how investors are measuring success.
Okay, tell us about that. It's not like a total revolution, but it's a definite nudge in a specific direction.
Precisely. In this latest survey, you see investors leaning much more heavily on, let's call them headline profitability metrics.
Headline metrics. Like what specifically?
Specifically, return on capital, or ROIC. That one came up again and again. It's really critical.
Okay, quick reminder for everyone, ROIC, that's basically how well a company uses the money it invests, right? The core test of value creation versus cost of capital.
That's the one. It's the fundamental check.
So investors still care how you get efficient or innovate, but now they want faster, more concrete proof that it actually turns into profit,
Yeah.
especially shown by ROIC.
You got it. And the why now connects straight back to the whole macro picture we're seeing.
Ah, the volatility.
Yeah, exactly. With all the ups and downs, interest rates moving, inflation worries, that risk-on, risk-off whiplash investors are looking for anchors. They want companies that can prove right now that they're really efficient with their capital, generating returns that can handle all that outside pressure. They need that proof of concept, or at least a really believable path to it, sooner rather than later.
Okay, that makes sense. Seeking stability amidst a storm.
So if that shift in measuring fundamentals is, kind of subtle, the change in what investors think makes a winning company has been, well, pretty seismic just in the last couple of years.
And I bet I know where this is going. The data points pretty clearly to one specific technology becoming almost table stakes now.
You guessed it, AI utilization. And what's really striking is just how fast it got baked into the investment mindset.
How fast are we talking?
In the newest survey, 31%, nearly a third of respondents listed AI and technology utilization as something a winning company absolutely needs in 2025.
Wow, 31%. And what about before?
Get this. When McKinsey did this survey back in 2023, AI barely even got a mention as a key feature.
Okay, that is a remarkable jump. Really mirrors the whole narrative shift around AI in the last, 18 months?
Yeah.
From nice to have to must have?
Totally. It went from future advantage to perceived necessity almost overnight, it seems.
All right, so if AI has shot up like that, we have to talk about the other big priority everyone's discussed for years, ESG, environmental, social governance. Did that see a similar surge?
No. Actually, we saw a slight dip there.
Marginally, but still a dip.
Really? How much?
In the previous survey, 20% of investors called ESG factors a top driver for long-term value. In this latest one, that number slipped just a bit, to 18% rating it very or extremely important. 18%. Okay, not zero by any means, but dropping 2 points while AI skyrockets. It does suggest maybe a shift in focus or attention bandwidth.
That seems like a fair reading. It probably doesn't mean investors suddenly don't care about ESG at all,
Right.
but it might be more about immediate pressures. The research also asked about the top macro worries for 2025, and they're pretty big existential things.
Like what?
Top of the list, geopolitical risks, then inflation and interest rates, and also government regulations and political risks.
Okay, yeah, those are significant headwinds.
Exactly. So when investors are busy trying to hedge against that kind of major external volatility, they naturally prioritize things like operational efficiency and technologies like AI that can, tangibly improve margins or help grab market share right now.
And maybe the urgency around broader ESG goals gets slightly nudged down the relative priority list, at least for the moment.
That seems to be what the data suggests, yeah. A reprioritization based on current pressures.
Okay, so we know investors are worried about the big picture, the external stuff, and they're focusing hard on operational efficiency, especially that ROIC number. How are they actually tracking that performance day in, day out? What are the specific numbers they're glued to?
Well, the data confirms they lean heavily on sort of a core trio of performance metrics.
For sure.
EBITDA, ROIC, there it is again, and EBITDA margins.
Mm-hmm.
Together, those really give a good picture of operational profitability and how efficiently a company's using its assets. For that longer-term potential, it still boils down to return, growth, and profitability. That's the holy trinity, you could say.
Right, the classic combo. But the report also stresses that just rattling off these numbers isn't enough. You need the right metric for the right company, depending on the sector.
Oh, absolutely critical. You have to tailor it. If you're a company that spends a ton on capital expenditures, think of heavy industry, utilities.
Sure.
Investors are going to be laser focused on hard cash flow metrics. Makes sense. But if you're, say, a software or a SaaS business,
Different ballgame.
totally. Then they're obsessed with retention and churn stats. Can you actually keep your customers and do it profitably? That's the key question there.
Okay, and this tailoring, this focus on the right numbers, it all feeds into what the report calls the equity story. That's the narrative you pitch to the market. What does that story need to do?
Fundamentally, it needs to grab attention, first off. Then it has to build real conviction in your long-term plan. And maybe most importantly, it has to be consistent.
Consistent across the board.
Yes. The research clearly flags an unattractive or inconsistent equity story as a major negative factor for investors. If you can't clearly articulate why your company deserves that long-term capital, well, you probably won't get it.
Which brings us to maybe one of the most surprising communication gaps the research found. It seems management teams are sometimes fumbling the most basic narrative tool they have, the elevator pitch.
Isn't that something? It sounds simple, but it points to a deeper issue. 21% of the investors surveyed called out elevator pitches as the #1 thing that's insufficiently communicated, but also most crucial to address.
21%, that's significant. And it's not just about being slick, right? It signals something more fundamental.
Exactly. It signals potential strategic inconsistency. If different execs, maybe even the CEO and CFO, give subtly different 30-second versions of the company's core story,
Uh-oh.
investors start wondering if everyone's really on the same page strategically. It undermines confidence right from the start.
Yeah, that would definitely give me pause. Needs to be tight.
And all this effort, clear communication, hitting the right performance targets, it's really aimed at attracting and keeping one specific, very valuable group of investors.
Which group is that?
The report calls them the long-term intrinsic investor.
Okay, intrinsic investors. Why should companies specifically try to attract them versus, say, index funds or short-term traders? What makes them special?
Well, because their whole focus is on fundamental value creation over the long haul. They're the ones most likely to actually champion a company when things get tough.
The sticky capital.
Right. They provide really valuable, often strategic feedback to management. And critically, they're the investors who help stabilize your shareholder base and will actually ride out market volatility with you instead of running at the first sign of trouble.
That sounds incredibly valuable. And the analysis actually put numbers on this, right? It looked at a whole decade of data.
It did, from 2012 to 2022. And the connection they found between attracting these investors and actual company performance is, well, it's pretty profound.
How so? What did the data show?
Okay, get this. Companies that managed to increase their ownership by these intrinsic investors over that decade significantly outperformed the companies whose intrinsic ownership declined.
Outperformed how?
They grew faster, almost 2 percentage points faster than their peers. They improved their ROIC, excluding goodwill, by nearly 3 percentage points more.
Wow. 2 points on growth, 3 on ROIC. That's huge over 10 years.
It really is. And crucially, they also saw an increase in their total shareholder return, or TSR.
And TSR, just to clarify for listeners, that's the total return shareholders get, stock price gains plus dividends. It's the bottom line measure of what the investment actually delivered to the owner.
Precisely. So when you see gaps like that, 2 points on growth, 3 points on ROIC over a full decade, that's a massive difference in outcomes.
Yeah, no kidding.
It really drives home the point that attracting the right kind of investor isn't primarily about slick marketing campaigns. It's about delivering sustained, superior operating performance.
So the ultimate lesson seems pretty clear then.
Unavoidable, really. Focus on running the business well, focus on that operating performance, and the right kind of long-term investors, they'll find you over time. Performance is the magnet.
Okay, so if superior performance is the magnet that attracts these valuable intrinsic investors, the report goes further and identifies 3 sort of archetypes or categories of action that define the companies who did this successfully.
Yeah.
What were those winning moves?
Right. The first category they identified was market share gainers. These weren't just companies riding a rising tide, they were actively taking share from competitors.
How are they doing that?
Through deliberate actions, things like really doubling down on digital channels, smart geographic expansion, and just relentless product innovation to stay ahead.
Okay, taking share. What's the second winning category?
The active capital allocators. This is where those strategic choices really come into play. How are you using your money?
Makes sense. Got an example?
Yeah, the sources mentioned a large industrial company that over a decade consistently dedicated a much bigger chunk of its cash flow than its peers to building up its internal digital capabilities.
A long-term bet.
Exactly. And that strategic patient allocation allowed them to fundamentally change their business and eventually offer much more innovative, superior products. It paid off.
Smart. Okay, and the third category of winners?
The third group were the operational transformers. These are companies that went through a really significant turnaround, maybe triggered by a crisis or something, but then crucially sustained that improved level of performance over the long run.
So not just a quick fix, but a fundamental rebuild of how they operate.
Precisely. They changed the core operating model.
All right, those are the winners. Now, let's flip the coin. What about the companies that saw their intrinsic ownership go down? What defined the losers in this context?
The report highlights 3 main categories there, too. First, unsurprisingly, the ineffective capital allocators.
The opposite of the winners.
Exactly. This often showed up in bad M&A, making acquisitions, but then completely failing to actually realize the synergies they promised. Basically, spending capital without generating the returns.
Okay, poor capital allocation. What else?
Second, the growth decelerators. These were companies often facing, long-term secular declines in their core markets. Think maybe some legacy consumer product areas, for example.
Right, swimming against the tide. And the third category of companies losing intrinsic investors. This one seemed particularly interesting.
Yeah, the valuation outliers. This is a really crucial counterpoint to the idea that performance is absolutely everything.
So,
Because these companies were actually delivering pretty solid operational results. Their performance wasn't the issue.
so why did intrinsic investors leave?
Because their stock valuation had just gotten so high, it seemed like all the good news, and maybe even more, was already baked into the price.
No room for future upside.
Exactly. Intrinsic investors always focused on that future value potential, looked at the sky-high valuation, and basically said, looks good, but there's probably not much more upside for us here. And they trimmed their positions, even with good performance.
That's a fascinating reminder. Valuation discipline still matters, even when the underlying business is doing well.
It absolutely does. Performance is key, but price matters too for these investors.
Okay, so we've seen what the winners do: allocate capital well, gain share, achieve operational excellence. Now let's shift to how these successful companies communicate. How do they keep those valuable intrinsic investors plugged in and confident? What do investors actually want from their interactions?
Well, one clear signal is the value placed on capital markets days, or CMDs. Investors really like these. 76% rated them as important or very important.
Okay, CMDs are valued. What's the key thing they want from a CMD?
The number one demand is a narrative that really emphasizes the long-term perspective. They want the 5-year plan, the strategic vision, not just an update on the next quarter.
Makes sense for long-term investors. Okay, what about the regular quarterly earnings call? That's the bread and butter for most market communication. What makes a good quarterly call in their eyes?
Interestingly, it's less about the slickness of the presentation and more about the substance. The most important factors cited were the materials shared, so the quality of the slide deck, the supporting data.
Got it. The actual information.
Exactly. Followed very closely by the perceived quality and credibility of the speakers themselves. The actual format or formality of the call. Much less important.
Substance over style. That leads nicely into what seems like a really critical final point from the research regarding high-value interactions. There's a real desire for less scripting.
Oh, absolutely.
Yeah.
That came through loud and clear. Investors put a very high value on meaningful, unscripted interactions with the key decision makers at the company.
Unscripted time, that's telling.
It is. And linked to that, they also expressed a desire to see more participation from a broader range of executives during Q&A sessions, not just the CEO and CFO fielding every single question.
Why do you think that is?
It suggests they're trying to look beyond the polished C-suite presentation. They want to gauge the depth of the management bench, understand if the strategic alignment goes deeper into the organization, it builds more confidence.
Okay, so pulling these action points together. A successful communication strategy needs to be anchored in those key financial metrics we talked about, ROIC, EBITDA margins,
Right.
but tailored to the specific sector. So showing things like retention rates for software or cash flow for industrials, and ultimately fostering that kind of open, maybe even slightly less scripted dialogue seems key to building the trust these long-term investors really value.
That's the essence of it. Performance first, then transparent, tailored, and ideally more open communication. Hashtag tag tag outro crazy. So, this deep dive really gives us a pretty clear roadmap of current investor priorities. The focus is definitely hardening around those measurable, tangible, profitable outcomes. ROIC is clearly leading that charge. And having a credible story, backed by action, on critical technologies like AI, well, that's fast becoming non-negotiable if you want to be perceived as a future winner.
Right.
And the evidence, honestly, is just overwhelming. Solid, consistent execution, strong operating performance. That's the ultimate magnet for attracting and keeping those really valuable, long-term, intrinsic investors.
It really is. And, that very specific repeated request from investors we just talked about, wanting meaningful, unscripted time with company leaders, that brings up a really interesting final question for you, the listener, to think about.
Yeah.
If a company's long-term success is so closely tied to performance and transparency, how much systemic risk are management teams actually taking on by maybe over-rehearsing, over-scripting every single interaction, every Q&A answer, every minute of a presentation?
Interesting question.
What does that investor desire for unscripted time fundamentally tell us about the current state of corporate communications culture and maybe about the true value of authentic trust in the marketplace today?
Something to definitely mull over.
Yeah. Something to think about as you consider how your own strategies align, or maybe should align, with what these high-value investors are clearly asking for. Thanks for joining us on The Deep Dive.